Jeremy, thank you so much for joining us today.
It's a pleasure to be here.
So Jeremy, why don't we start by you just introducing yourself, saying what you do and how long you've been doing it.
So I'm the Global Chief Investment Officer at WisdomTree. So we're an $80 billion global asset manager across the US and Europe, primarily ETFs today, about $50 billion in the US and $30 billion in Europe. I've been at WisdomTree for 17 years, so the second longest employee after CEO Jonathan Steinberg. But I got introduced to WisdomTree from my association with Jeremy Siegel from the Wharton School. I've been working with Jeremy for the last 21 years. We passed our anniversary. We just actually released the 6th edition, and he added me as a co-author to his seminal book, Stocks for the Long Run. So 6th edition is out. I have this great relationship with Jeremy, great relationship with WisdomTree. So that's what I do.
So now, seeing as you mentioned Jeremy, the legend that is, I'd love to know more about him. His predictions have just been so good for so long.
Yes.
What is it about his process that means that he keeps making, and I think we were talking earlier about his inflation cycle prediction in particular has been so good. What is it about his process that he just gets so right?
You know, people call it because of Stocks for the Long Run, right? And Stocks for the Long Run is generally right. So people call him a perma bull. But I've known him for 21 years, and he definitely is not a perma bull. I mean, he tries to call it as he sees it, which most of the time, 75% of the time, is to be bullish stocks. But when I first started working for, I was in his class at Wharton when he first came out in March of 2000. He had an op-ed, big cap tech stocks are a sucker's bet. March 14th of 2000, literally the day the NASDAQ peaked, and he had 9 stocks, triple-digit PEs, and he could never justify those valuations. So that was put him on the map, was that op-ed. But that's what got his own research into value investing, and I helped him with the Future for Investors. That was all about high dividends, value, low PE, until you get another growth cycle, right? It actually took a while. This year has been the year return of value, but it was a 15-year dark period. Growth was leading the way again, but he does believe in a lot of value investing. What's interesting about the inflation, he was trained at MIT as a monetary economist. So he got into finance, self-taught on the markets because he just loved the markets, but self-taught there. He was trained as a PhD in monetary econ. So he's been railing on the Fed. So he saw the inflation before really anyone, honestly. So right after, 2 months after the pandemic, with all the stimulus relief efforts and then the money printing, the money supply, there's an explosion the M2 money supply. He's like, there's going to be inflation. And from May of 2020, he called it. And then he was early on saying, this is going to be a problem, but the Fed's not doing anything about it. The Fed was saying it's going to be transitory. He's like, no, it's going to be a problem. And he would say he studied under Milton Friedman. So he went to Chicago to teach with Milton Friedman for 4 years. So he had that Friedman in him. But I remember at the end of last year, the Fed was saying there's going to be 3 hikes, and he was saying there's going to be 8, and people looked at him like he was on a different planet.
Wow.
And obviously we've done a lot more than 3 hikes.
He's got that spot on.
And what's interesting now is he's saying inflation's done. So he's saying the real world inflation is no longer.
When you say inflation's done, do you mean we're just in a higher inflation world now?
It means that the Fed should stop, that they've done enough, that the money supply, which was expanding at explosive rates, is now contracting. It's contracting over the last 7 months. You want it to grow 5% a year, which is 2% real growth in the economy, 2 to 3% inflation. We're contracting. That's a problem. And so that's going to say inflation is going to come back down. But in the real world, it's already coming down. So the Fed looks at this core CPI that has 40% housing, which in the real world is coming down, but in their inflation statistics is going up.
Well, isn't this one of the core problems with what the Fed does, which is take future decisions on backward-looking information? But so how do they get around this?
Be able to look in the real-time things, and it's all.
But then you have an accountability issue, because if Jerome Powell is saying, "Why did you make this decision?" he can't say, "Because I think this is going to happen in the future." He can't get fired for saying, "Oh, that is the data."
He's just looking at the wrong data.
Yeah,
he was looking at the wrong data. This week the market sort of cheered yesterday.
Yeah.
What we're here on December 1st. They had a speech November 30th. They cheered. NASDAQ exploded. S&P exploded. That we might go from 75 to 50. But he didn't change his actual narrative. You read between what he actually said. He's still sticking with this narrative that we've got to keep it at this rate, elevate. Okay, well, they should stop in December. They probably will keep going, right? So they'll keep going from 50, 25, 25, get to 5. hopefully they stop at 5, but they should stop in
Now.
December.
And when you say stop, you don't mean stop and the next move would be a cut. It's stop, pause, let things catch up.
Yes, let's start seeing it.
Yeah.
But Siegel actually is saying they're going to start cutting next year and that they could be back to 2%. That's a little aggressive. So he's out there being on the aggressive side. That might be what they should do versus what they will do. But he's starting to get on, they need to start cutting because inflation's coming down. They're going to have a more serious slowdown. They're already too restrictive.
So how do you think stocks play out over the next 6 to 12 months?
Well, it's the further the Fed keeps looking at the wrong data, the more problems we have. And we already think they're too restrictive now. That will cause a slowdown. It will cause a recession. There's a lot of things that say we are in a recession. I mean, the unemployment hasn't picked up meaningfully, but you could see it's coming. Housing is slowing, basically screeched to a halt. That's going to have ramifications. And you're starting to only minor see the tick up in layoffs. Tech has had the most layoffs in 20 years. Manufacturing starting to come down. So the economy is going to weaken.
Are you surprised by the strength of the labor market? Are you surprised that it hasn't come off more?
Well, we're back to a little bit before. We're lower than pre-pandemic, and there's people who left the labor force. This is one of the issues. That you had the retirees, and it was a real issue. It's like getting people back. Are they going to get people back into the labor force?
Well, what I've heard, sort of, anecdotally, is that there's a lot of large corporations who are too scared to do big layoffs because just hiring back talent is very difficult and very expensive. So people are just holding on to employees perhaps longer than they should.
I mean, if you're in the market for tech employees, which I think everybody is, I think it's finally going to start to get better. I mean, you see Twitter laying off 75% of the workforce.
Yeah.
You're starting to see the crypto. And in the financial services, if I lost people last year, I was losing them to crypto firms because the money was flowing. And for sure, up to like December, there's a lot of money flowing, a lot of money going around, and they're hiring a lot of people. Right now, you're starting to see exchange cuts 30%. Exchange cuts 20%. You're seeing more of those news flows. So I do think it's going to get easier. Like it's going to be easier to rehire people. I have people who left who potentially could want to come back. Yeah. More than one.
Well, Jeremy, I want to talk more specifically about wealth management. I feel like I could talk to you for hours about markets, but specifically about wealth management. How do you feel that business model, that world has changed over the last 5-10 years to where we are today?
Well, there's been all sorts of trends. I mean, you started seeing the rise of the robo-advisor as one of the big stories. In asset management, which is the key components a lot of the wealth managers use, you saw the big transition from mutual funds to ETFs. Fees have come down everywhere. Like, right, in asset management, it's coming down. I think the more...
You mean fees on products or fees on managing money?
For sure on products. And I think the question is, have they come down on the wealth management side? The robos put some competition for that, but then the question is, do you get the same level of service? I think one of the other threads happening at the conference today is digitization and crypto and using blockchain infrastructure to re-architect some of your infrastructure. That's something that we're focused on at WisdomTree, is sort of the future of finance going to blockchain-enabled wallets. We've talked about building WisdomTree Prime, which is sort of tokenizing mainstream assets. It'll be direct to consumer, and that the blockchain rails does cut out a lot of costs, and it will make things very cost efficient over time.
So what do you mean by mainstream assets? Because obviously that would include, cryptocurrencies I can see as being digital assets, but what else do you put in that bucket?
So we were the first firm approved to do tokenized treasuries.
Wow.
So we have a tokenized treasury fund that was made effective. And
that's live now?
We have minted our treasury. Right now it's in beta mode, so employees at WisdomTree have access to playing around. I have it on my phone. And so people do have access. I mean, it will be rolling out hopefully nationally in Q1. But we have a gold token in there, there's cash, there'll be treasuries. We have 9 filings for further, like we had the template approved now with the first fund with treasuries, and people can do some research on what are the other filings in the pipeline. But it's going to be a robust next 12 months on more filings for more tokens. But this is treasuries, it's equities, it's mainstream assets.
So I want to ask one more question, which is, as you look out into 2023, we're trying to identify what trends we're going to see. So if you were to make one prediction going into 2023 about what kind of changes we may see in wealth management, what do you feel we might see?
It's a good question. I mean, I volatility still reigns supreme. So you had this period where bonds were the best diversifier for stocks. This year, they lost that diversification.
You mean the 60-40 rule kind of
60-40
worked forever and it just didn't?
Yeah. And so now they went down together. And then the question will be, will they start working together? Will rates keep rising and will that pressure stocks? Or do you need to find other diversifiers? And so I think building more well-rounded portfolios away from stocks and bonds remains a key topic for me. And will rates stay? They've got some real yield that people call it. There's no alternative. The TINA model that you had for so long,
Mm-hmm.
There's starting to be real yield, or there's a real actually attractive yield.
Yeah.
Now positive yield and high yield, you get 8-9%.
Mm-hmm.
So that what are the other diversifiers is going to be, I think, one of the open questions. Now that you saw stocks and bonds go down, will there be people continue to look for other places for that?
And I am just going to ask one last thing, just on housing, just because you brought it up. Do you have a view on how you think the housing market will play out over the next 6 to 12 months in this high rate environment? Will it be particularly geographical, or do we think we'll see a general slowdown?
There are a few interesting facts. So the money, we talked about the money supply and inflation. So the money supply went up 40% from prior to the pandemic to March of 2022, before it started contracting. So money supply up 40%. The Shiller Case Index also went up 40%. Interesting little factor there. It wouldn't be surprising to see at 6.5 to 7% mortgages a 10 to 15% pullback. I mean, that I think is probably what you could see. It's not like we're going back all the way to pre-pandemic, and I do think rates will slide back down, and that'll put some more relief on that. But yeah, we would expect. In real world, in the housing are starting to come, but there's not a lot of activity because people are used to the old prices, but the new mortgage people don't want to pay the elevated prices. So there's a stalemate. Yeah. But it's going to, we think, settle down. We've been saying 10 to 15% lower.
Well, Jeremy, this has been a fascinating conversation. I just want to say thank you for your time.
Thank you for having me.